Something big just changed in the gold and silver markets, and most investors still haven't realized it yet. Just days ago, markets were reacting to war headlines, oil shocks, and geopolitical fear. Gold was moving as a classic safe haven. Silver was swinging wildly with uncertainty. But now, the entire direction of the market is shifting, and it's happening fast. Right now, gold prices in the United States are pushing back toward the $4,700 to $4,800 range, showing strong resilience after recent volatility. At the same time, silver is making aggressive moves, jumping several percentage points in short bursts and outperforming gold in the short term. On the surface, it looks like a normal rebound, but it's not, because this time, the driver is completely different. The biggest force controlling gold and silver right now is no longer war, no longer oil, and not even inflation alone. It is the policy outlook from the Federal Reserve, and more importantly, what markets believe the Fed will do next. Recent U.S. economic data has started to weaken. Job growth signals are softening, growth expectations are cooling, and this is triggering a major shift in expectations across Wall Street. Investors are now increasingly betting that the Fed could move toward interest rate cuts later in 2026. And that changes everything, because when interest rates fall, the US dollar typically weakens. And when the dollar weakens, gold becomes more attractive globally. It's priced in dollars, so a weaker dollar makes gold cheaper for international buyers and increases demand. That's exactly what we're starting to see. At the same time, institutional money is quietly returning. Large funds are stepping back into gold through ETFs like Spider Gold Shares, GLD, signaling renewed confidence in the long-term trend. This isn't panic buying, this is strategic positioning. And silver? It's reacting even more aggressively, because silver doesn't just follow gold, it amplifies it. With growing demand from U.S. industries like solar energy, electric vehicles, and semiconductor manufacturing, silver has a second engine behind it: industrial demand. That's why when momentum builds, silver tends to move faster, sharper, and with more volatility. So right now, we're seeing something very unusual. Gold is holding strong because of policy expectations, while silver is accelerating because of both policy and industrial demand. This combination is rare, and it's powerful. But here's where it gets even more interesting. Despite this bullish setup, the market is still fragile. Just a few days ago, both gold and silver saw sharp drops when the US dollar strengthened, and investors feared that rate cuts might be delayed. That tells us one thing very clearly. This market is extremely sensitive. One data release, one Fed signal, one shift in expectations, and everything can move fast in either direction. So the big question now is, are we at the beginning of a major breakout in gold and silver? Or is this just another temporary bounce before another drop? To understand where gold and silver are heading next, you need to look at one thing above everything else right now: the US dollar. Because whether most people realize it or not, gold and the dollar are moving in opposite directions almost all the time. And recently, this relationship has become even more important. Just days ago, the dollar was gaining strength. Investors were moving into it as a safe and stable asset, especially during geopolitical tension and uncertainty. That strength in the dollar created pressure on gold and silver, pushing prices down sharply. But then something changed. As expectations for future rate cuts started building again, the dollar began to lose momentum. And the moment the dollar started weakening, gold and silver immediately reacted. This is the key connection you need to understand. When the US dollar index goes up, gold usually struggles. When it goes down, gold tends to rise. And right now, the market is watching every move in the dollar very closely. Because it's not just about today's dollar strength, it's about where the dollar is expected to go next. If investors believe the Federal Reserve will cut rates, the dollar weakens in anticipation. And that creates a powerful tailwind for gold. Now here's where it gets even more interesting. We are starting to see a divergence between short-term and long-term expectations. In the short term, the dollar can still spike higher if strong economic data comes in. For example, if inflation suddenly rises again, or job numbers surprise to the upside, markets may quickly adjust and push rate cuts further out. That would strengthen the dollar again and create temporary pressure on gold and silver. But in the bigger picture, more and more analysts are starting to believe that the trend is shifting. And this is why gold is holding its ground, even after volatility. Instead of collapsing, it's stabilizing. Instead of breaking down, it's finding support. That's a very important signal. Because in previous cycles, when gold starts holding strong despite negative pressure, it often means that large players are accumulating positions quietly in the background. And we're already seeing signs of that. U.S. institutional investors are gradually increasing exposure through futures markets and ETFs. This isn't emotional buying. This is calculated, strategic movement based on expectations about where the economy and monetary policy are heading. Now let's bring silver back into the picture. Silver reacts to the dollar too, but it does something extra. It exaggerates the move. When the dollar weakens, silver doesn't just go up, it tends to surge. And when the dollar strengthens, silver doesn't just fall, it can drop sharply. That's exactly what we've seen recently. Sharp drop, strong rebound, another surge. This kind of behavior tells us that silver is becoming a high-momentum asset in the current environment. And that creates opportunity, but also risk. Because in markets like this, timing becomes everything. So now the market is entering a very critical phase. If the dollar continues to weaken and rate cut expectations grow stronger, we could see gold push toward new highs and silver accelerate even faster. But if the dollar regains strength, even temporarily, both metals could face another wave of selling pressure, which means one thing. The next move is going to depend heavily on what comes out of the U.S. economy next. Now let's focus on what could become the biggest catalyst for gold and silver in the coming weeks. U.S. economic data. Because right now, the entire market is in a waiting mode. Investors are watching every single data release, jobs, inflation, growth, trying to figure out one thing. What will the Federal Reserve do next? And this is where things start to get really interesting. Recently, U.S. data has been sending mixed signals. Some reports suggest the economy is slowing down. Job growth is not as strong as before. Certain sectors are showing signs of weakness. And when that happens, markets immediately start pricing in rate cuts. That's bullish for gold and silver. But at the same time, inflation is not fully under control. There are still concerns that prices could remain sticky. And if inflation stays elevated, the Fed may decide to hold rates higher for longer. That's bearish for gold and silver in the short term. So right now, we're stuck in a tug-of-war between two forces. On one side, slowing growth pushing the Fed toward rate cuts. On the other side, inflation pressure forcing the Fed to stay cautious. And this uncertainty is exactly why gold and silver are moving so sharply in both directions. Now here's what most people miss. Markets don't wait for the Fed to act. They move based on expectations. If investors believe rate cuts are coming, gold starts rising before the Fed actually cuts. If they believe cuts will be delayed, gold starts falling even if nothing has changed yet. So the real battle is not about what the Fed is doing today. It's about what the market believes the Fed will do tomorrow. And that belief can change very quickly. For example, one strong inflation report could suddenly shift expectations. The market could go from expecting rate cuts to expecting delays. The dollar would rise, and gold could drop sharply. But if we get weak job data or slowing growth signals, the opposite happens. Rate cut expectations increase, the dollar weakens, and gold and silver push higher. This is why upcoming U.S. reports are so critical. They are not just numbers, they are triggers. Triggers that can move billions of dollars in seconds. Now let's bring silver back into this discussion again, because this is where things become even more explosive. Silver doesn't just react to monetary policy, it also reacts to the real economy. If U.S. growth slows too much, industrial demand for silver could weaken, which would normally be bearish. But at the same time, if that slowdown forces the Fed to cut rates, the monetary boost could push silver higher anyway. So silver is caught in a unique position. It is influenced by both economic weakness and monetary easing. And depending on which force is stronger, it can move very aggressively in either direction. That's why we are seeing these rapid swings. And that's also why many traders are now focusing more on silver than gold for short-term opportunities. Because when the move comes, silver tends to move first and move faster. So as we move forward, one thing is clear. The next big move in gold and silver will not come from headlines alone. It will come from data. Now let's talk about something that most retail investors completely overlook, but institutions never ignore, and that is money flow. Because while headlines move the market short-term, real trends are built by where big money is going. And right now, we are starting to see a very important shift. After the recent volatility, institutional investors in the United States are slowly stepping back into the gold market. Not aggressively, not all at once, but quietly, strategically, and with clear intent. One of the biggest signals of this is coming from ETFs. Funds like SPDR Gold Shares, GLD, are beginning to see renewed inflows again. That tells us that large asset managers, hedge funds, and long-term investors are starting to rebuild their positions. And this matters more than anything else, because institutions don't chase hype, they position early. When they expect macro conditions, like lower interest rates weaker dollar, and economic slowdown. To support gold, they begin accumulating before the full move happens. That's exactly the phase we may be entering right now. And there's another layer to this story. Central banks around the world have been consistently adding gold to their reserves over the past year. While this is a global trend, it directly impacts U.S. markets because it reduces available supply and strengthens long-term demand. So now you have two powerful forces working together: institutional investment demand and sovereign demand. That combination creates a strong foundation under gold prices. But here's where silver changes the game again. Because unlike gold, silver has a much smaller market size. That means it takes less capital to move it. So when investment money starts flowing into silver, even a fraction of what goes into gold, the price reaction can be much more dramatic. And we are already seeing early signs of that. Funds tracking silver, like iShares Silver Trust, SLV, are beginning to attract attention again. Retail investors are also stepping in, drawn by the idea that silver is cheaper than gold and has more upside potential. But that's only part of the story. Because silver is not just a financial asset, it's also a critical industrial metal. And U.S. demand is growing fast. From solar panel production to electric vehicles and advanced electronics, silver is becoming increasingly important in the modern economy. This creates a second layer of demand that gold simply doesn't have. So when you combine investment demand with industrial demand, you get explosive potential, but also increased risk. Because if industrial demand slows, silver can fall faster than gold. And if investment flows reverse suddenly, the downside can be sharp. This is why silver behaves so differently. Gold is stability, silver is momentum. And right now, both are being pulled higher by the same macro force: expectations of future monetary easing. But the speed and intensity of their moves are completely different. So now the market is reaching a very critical moment. Institutional money is slowly returning, retail interest is building, and macro conditions are starting to align. The question is no longer whether gold and silver will move. The question is how strong that move will be, and who is positioned before it happens. So now everything comes down to this moment. We've seen the shift from war-driven markets to policy-driven markets. We've seen how the Federal Reserve is now the single biggest force behind gold and silver. We've seen institutional money quietly stepping back in, and we've seen silver gaining momentum with both investment and industrial demand behind it. But what happens next? Right now, the market is standing at a turning point. If upcoming U.S. data continues to weaken, especially jobs and growth, expectations for rate cuts will become stronger. That would likely weaken the dollar further and push gold toward new highs, potentially breaking above recent resistance levels. And if that happens, silver could accelerate even faster. Because once momentum builds in silver, it tends to attract both traders and retail investors at the same time. That's when moves can become explosive, not gradual, but sharp and fast. However, there is another scenario you need to be ready for. If inflation surprises to the upside, or if the U.S. economy shows unexpected strength, the Fed could delay rate cuts. That would strengthen the dollar again and create pressure on both gold and silver. And as we've already seen, this market can turn very quickly. So the key takeaway is simple. Gold right now is being supported by long-term expectations, while silver is being driven by momentum and demand. Both are bullish, but both are sensitive. And that means opportunity and risk exist at the same time. This is not a slow market. This is a reactive market. Every data release, every Fed signal, every shift in expectations can move prices rapidly. And that's exactly why so many investors are paying close attention right now. Because we are not just watching a normal trend. We are watching a potential setup for the next major move in precious metals. And whether that move turns into a breakout or another sharp correction will depend entirely on what comes next from the U.S. economy and the Federal Reserve. If you want to stay ahead of these market moves and understand what's really driving gold and silver in real time, make sure you subscribe to the Gold and Silver Updates and stay connected for the next updates. Because in markets like this, being early is everything.